Well, I think this is a really big moment in time. Um, there have been the phases of insurtech. The first was, it's disruptive. Who are these kids and how dare they? Followed by the partnership model, which was they seem to be doing really cool things, but they can't get that far without us. So why don't we go and talk to them? And we're in that very much in that phase now. Some really good things coming out of these partnerships. But
I'm Matthew Grant.
I'm Robin Merttens, and we're InsTech London.
And this is the future of insurance.
This episode is brought to you by Medallia, the market leader in customer and employee experience. Their award-winning SaaS platform, Medallia Experience Cloud, makes all your other applications customer and employee aware. Medallia uses proprietary AI and machine learning to reveal predictive insights that drive powerful business actions and outcomes. Leading insurers like Prudential and Zurich use Medallia to reduce churn, turn detractors into promoters, create in-the-moment cross-sell and upsell opportunities, and drive revenue-impacting business decisions. Learn more at medallia.com. And the Future of Insurance book series, available exclusively from Amazon or at future-of-insurance.com.
Robin, Matthew, thank you so much for joining me for an open discussion. Not really a one-way interview this time, but all three of us having some fun. So thank you.
A pleasure. Good to be here.
Well, thanks, Brian. Really looking forward to it.
Yeah, I do want to open with just a sense of what InsTech London is and what you do with it. What's going on these days, and especially as you came from a place of hosting events, getting everyone together, had to pivot quite hard, but did that really successfully, and now you're looking at coming back together again. So I'm curious about whether the format's changing, what you do, and how that sort of looks going forward.
I'll kick it off, Matthew. Yeah. I mean, we're a community. We're based in London, but increasingly we're a global community. Intriguingly, for your audience, with something like 25% US engagement now. We're funded by corporate members, of which we have around 120. We have around 20,000 individuals who transact with us, or deal with us, or listen to what we have to do one way or another. And our purpose is to sit at the nexus between technology, innovation, and insurance, and to promote it, and to kind of use our network to foment good things and to bring intelligence to the party by talking to a lot of people and playing back to them, what we hear and the insights we gain.
Yeah, there's this really interesting situation in London that I have not seen anywhere else in the world, just given the confluence and concentration of insurance professionals all around, Lloyd's and as sort of a radius around it. You get every kind of insurance related activity in different parts of the market really hubbed up very, very tightly. I always said everyone you need to see is sort of within a 10-minute walk if they don't happen to be in the exact same place as you anyway. So it does feel like London was really well positioned for this sort of collaborative mindset to spark up. Is that sort of the genesis for it, or is that what you've seen?
Yeah, I mean, Brian, as you say, London is a hub, partly because, from the perspective of anybody looking at innovation and insurance, so much of the global insurance comes into London, or I should probably put it the other way. So much of what London writes is outside of the UK. So not only do you have a lot of people there, but you get this interest from global business, particularly the complicated, somewhat messy commercial specialty business. It's also just because the nature, it is historically preferred to buy versus build. It's often a great testing ground for innovation, actually. I mean, Lloyd's itself obviously started off being very innovative, but the people there really are at their best as underwriters when they're entrepreneurs and they're looking for new opportunities, and they need to understand how to price and select risk, but they're always looking for a way that they can get the confidence in the risks they're writing and find some new solutions. And when it works at its best, you get that fantastic group of people together from all different angles, bringing the ideas, bringing the capacity, and getting things done.
So with COVID, when you start off as being a very in-person kind of event, like let's all come together after work and discuss, the issue of the day, or some of the trends that we're seeing developing. You had to pivot quite a bit. I'm curious, Robin, you mentioned 25% of the engagement is outside of the UK, or is US based, you said actually. Was that the way it was before, or is this, I'm curious about the COVID pivot, and maybe that was a bit of an opportunity for you to globalize a bit.
It has been a big opportunity. We started as a networking community, and to your point, we would have events, put some pretty ordinary white wine behind the bar and get 200 people. In the early days of InsurTech, it was all about pitch events. We would have a theme, we would find 6 or 7 companies, we would give them 5 minutes, we'd interview them. And of course, as you rightly say, that came to an abrupt end for us, in March last year. And then there's a natural step to that. You put it all online, and we had really big audiences, I have to say, to start with. But there are certain sort of fatigue set in over time. But that was when we pivoted to what Matthew and I would now call an intelligence business. We used the time to talk almost like monthly to every single member that we have. We have a lot of inbound startups who talk to us anyway, and rather than let that happen naturally at events, we start to collect that in and start to write leadership reports, and to start Matthew, with his podcast, to start to collect those people in and broadcast in slightly different ways. And within 12 months, we picked up a global audience, and we were we were really doing, I think, the same thing. At our core, we are a dating agency. We know what people are looking for, and we know what's out there, and we're making those links, and we're also using those cores and the people we know and we can talk to regularly to define what the themes are, and the topics are, and make sure that we're writing about and broadcasting the sort of things that people are genuinely interested in at that moment in time.
So when you say themes and what people are interested in, I want to get into that because of this position that you're in and those conversations you're having. What are some of the hot themes and the things that you're seeing that, I've seen some of the reports, you have dove deep into a few of these, but there's more to come, I imagine. So there's got to be a lot of things that you're looking at that could be driving quite a bit of change and opportunity for the industry.
Yeah, I mean, with the themes, Brian, what's driving those is areas that in most cases people will be familiar with them or have heard about. So parametric insurance is a good example. Robin did just one on embedded insurance we're going to talk about. But often, and I think this is back to Robin's point about sort of intelligence gathering, people don't really know the totality of the topic. Parametric, for example, has been around for 20 years with some very large deals done through the capital markets using parametric triggers. But a lot of what we're seeing now, and that's not to say it's wrong, it's just different, is going through small businesses and looking at more innovative ways of doing it. And because we are, both Rob and I have got quite a long history in the industry globally, and we're talking to people fairly regularly, what we're trying to do is just help understand what is the breadth of what's happening in these areas. And we certainly don't rely entirely upon ourselves. We're very fortunate in being able to dig into some experts in this area, including help for yourself. But looking at those themes, so parametric, I suppose, is the first one that we could talk about. There's a couple other ones if we've got a chance. It'd be great to dig into. But happy to unpick those a bit.
Yeah,
more.
no, let's do that. And parametric, it's been front and center in so many discussions for a while, and still feels like it hasn't done it yet. And I know there's some pockets where it has. You guys had a really interesting discussion on your show about vaccine delivery and making that a parametric cover tied with an IoT device. That was fascinating to me. But again, that's a really kind of esoteric and niche application of it. It's not to the level of your motor insurance where everyone's got it and it just works that way. So I'd love to hear more about parametric. And is there a precipice? Is there some development that has to take place before it can get into the mainstream, or is that really the path for it at all?
Well, tough question, putting me on the spot on the precipice. The one you referred to is Postle, excellent company. They went through the Lloyd's lab, based out of the US, actually. Yeah, so they've got a way of measuring the temperatures that vaccines are transported at, and COVID, a lot of the early COVID vaccines had to be kept very low temperatures, and it's a very simple parametric product, complicated to build like a lot of these things, but if it goes below a certain temperature, then basically a payment is made on that trigger. To your question, I mean, what we're seeing is that parametric is most suited where there is no traditional conventional alternative insurance, and the market is either pricing it really high because it doesn't understand it, or you simply can't get it. And so therefore you've already narrowed down the area. I think the one thing that we're going to see a lot more, and this is a sort of COVID effect as well, is in non-damaged business interruption. So clearly a lot of the losses that were suffered from COVID were loss of revenue for lots of reasons, but it's quite difficult to actually pin that to a specific act. Traditionally business interruption would happen from some kind of damage or very explicit lost revenue. With things like some of the payments going through organizations like a MasterCard or a Visa, it's now possible to track what those actual payments were at the aggregate level, and therefore you could build a trigger on that basis. So that's where we're going to see it. But you're right, there's probably 2 or 3 companies at scale offering sort of SME, small business type parametric that are successful. I call out Descartes and New Paradigm Underwriting, who are doing that mostly in the natural peril area. It is going to keep growing. There's a lot of early companies coming through, and it's relatively, I wouldn't want to say easy, but there's a lot of data out there that's free or almost free. That means getting the data that forms the basis for the trigger is relatively straightforward. So back to Robin's point that we'll probably talk a bit more about, it's really then ultimately, can somebody building those kind of triggers find the capacity to back them on the one hand, and then can they find the distribution, i.e. can they find brokers who are willing to understand it and sell it to their customers? And that's really ultimately what's going to define whether these are successful or not, is do the brokers get behind it, and are they willing and able to sell it to their customers?
I make a little add just like to that. Funnily enough, outside of more sort of cat-related parametric, in other words, the capacity, the insurers are really keen on parametric insurance. It's a nice diversification play. They see it as an adjunct to what they do. So the capacity as a whole has not been a problem. The distribution, really good data sources, but the brokers, I don't feel, have been yet convinced. So acts getting out in what amounts to a B2B2C play, I don't think anyone's cracked distribution at scale yet. And it's not because of the quality of the offerings. The offerings are really, really good in most cases.
It just feel like, on the one hand, it'd be perfect for a direct play because the payout, like, you can understand it. So it removes a lot of that uncertainty. The flip side is, I'm not sure that consumers are ready to believe that. And sort of, is it really that simple? Am I missing something? I don't think we're at a place where the trust in the process and the ability for it to play out is quite there. I think there needs to be some proof cases from maybe some of the intermediated spaces where people see, oh no, this is a thing. Like anything. I mean, I remember the earliest days of cyber where, that you couldn't pay people to take the coverage. And of course now it's A, it's cheap as chips, and B, everyone's got to have it, and it's built into lots of other coverages. It's the same thing for lots of things when they first come out. But it feels like it could very well play out direct to consumer because of the simplicity of it, if people believed in the simplicity. And I don't think we're there yet as a market.
Yeah, I guess a couple of things. I mean, on the, bear in mind for London and the Lloyd's market, where some of that, not all of it, but some of that innovative capital is coming from. We've also obviously got the big players like Munich and Swiss. That is a broker market. So if they're going to put it behind it, they have to go to a broker, whereas some of the other insurers don't. And I think from the point of view of the consumer, as you said, the consumer they don't want to care about whether it's parametric or not. They just have to, they have to be comfortable it's going to get paid out. And likewise, the brokers are offering it, and they almost don't tell the client it's parametric. It's just you're going to get a
Right.
payout. It's a curious area where the companies celebrate when they have a claim. So Flood Flash, for example, that's putting sensors inside of buildings that measure the flood height. Yeah, they got very excited when there was a flood in some part of England, and people got a payout made almost, they woke up in the morning and there was a flood in their building and the money was in their bank account before they'd even realized that they'd got flooded virtually. That was a big success story for them. So as you say, until these things are proven and people see how well they work, and the miss factor is not meaningful enough to get in the way, then yeah, the motivation is going to be a little bit slow. And like all things, until there's a loss, or until you suffered a loss, or until you find you can't get insurance and you wish you had, kind of barrier to being able to buy it.
Yeah. That's the perverse nature of a lot of us in insurance, where, I remember anticipation of a big Atlantic windstorm. It's a weird combination of claims people being very nervous, people who are running the capacity on the reinsurance side maybe being excited because maybe that would bring some hardening on the rates. So, it's just a weird push and pull, but it's like ultimately all of this is because people are going to be in a bad way. So, it's never good. But yeah, we do have strange different desires and needs, and you want to prove the case, prove that it's worth something, prove that your business works, and you have the ability to stand up and say, look what we did for people. But of course that means people were still experiencing a flood, whether they got cash or not. Still very difficult. I say that as someone who's had a flood in my home, so I'm always sensitive to it. And my insurer did not cover it as well. They should not have, because I didn't have cover. Anyway, not about me. What other themes and things that are popping right now are you seeing?
I think closely related would be embedded. What I mean by that is that seems to be an easier way to get the trust and buy-in from consumers and customers. Again, it's been around for a while. Some of the very best proponents of it were early insurtech companies founded 2016, 2017. So it's not new. What is new is the excitement about it.
Yeah.
Because it's starting to work. Everyone's starting to talk about it. Everyone's starting to see it as a solution to quite a few problems. One, obviously, protection gap, where it's being used to get insurance to people who wouldn't otherwise have the ability to buy it. I really like some of these micro insurance cases around embedding insurance into the seeds when you buy them, such that if anything happens to the seed or the climate or the, that's it's baked in at point of sale, and it's providing an insurance that didn't exist before. I think that's an exciting play. But more than anything, what it's doing is providing a genuine digital experience in a way that the insurance industry's really struggled to provide before. So you're effectively taking and lending to somebody else your technology and your ability to, your little customer journey, and embedding it in what somebody else is providing and somebody else's ecosystem, such that it becomes the ability to offer insurance on exactly what it is, they're doing or they're buying at exactly the right point in time, with optimal reuse of the data in a nice, simple transaction. And a bit like, it's just become a proven model for delivery now, and unlike nearly everything else in insurtech, at least theoretically, every party to the value chain wins. Distributors get the chance to make a bit more money. Insurtechs get distribution. Insurtechs get to play in most cases providing the technology. The capacity gets new and different sources of distribution.
Yep.
And if we do all that and close the protection gap, then it, everyone's a winner. And I think because it's possible to make the case that this is a sort of win-win-win, it's really got the tailwind behind it.
Yeah, I was talking to a venture capitalist who they've made some investments in some. Actually, I can say it openly because the receiving company and the VC have both been on the show, and we talked about it. But American Family Ventures has some embedded investments. And Caitlin Johnson, who was on the show in an earlier episode, one of the points she made, I think it's episode 4, was, and I don't know why this didn't occur to me, but it's brilliant, is there's no competition for that sale then. I mean, the competition is someone solves for it another way if it's a coverage that you could buy a different way, like motor. It's part of the car buying experience when it's embedded versus you go talk to your agent or you go online or whatever. But something, Robin, like you're saying, the seed coverage, yes, you would get crop insurance, but it's just going to be a slightly different proposition. It's going to work differently. You're not thinking, do I buy these seeds that have it baked in, or do I buy these other ones and then go get crop insurance? You probably still need the crop insurance. It's just going to be different. So here there's no competition for selling that particular kind of coverage because it's baked in. There's no shopping moment around the insurance, which frankly your competition is really not buying. But it's the exclusive distribution that I hadn't really thought through, that actually from the insurer, the MGA, whoever's putting the embedded offering in there, is brilliant. You don't have to compete with that. You can just worry about getting the right construct for that particular issue, that particular exposure, without then having to get into marketing and advertising and all the other things that can take away from just addressing the exposure itself.
Yeah, I mean, I think, Brian, the other way I think about it is if you look at Amazon probably 5 years ago. I mean, certainly in the UK, I'm not quite sure it is in the US, but it's pretty unusual then to be able to buy something and return it easily. There's a whole host of hoops you had to jump through.
Yeah.
But now with Amazon, you buy it, no questions asked. If you don't like it, you return it. And you can sort of see the next piece of that is you buy something, it gets broken or it gets lost, and you just claim for it, because you just assume that your insurance is built into your purchase. So that's how powerful it gets. But of course, that's a big threat, as Robin writes about in the report, is a big threat for the existing insurance companies, because then what is their role if they, particularly often the brands of the distributors or the retailers are stronger than the brand of the insurers? What's their role to play in the whole embedded insurance equation? So in that if you talk about sort of disruption and threats to the industry, that seems to be a major one that hasn't yet played itself out. I
do think this brand threat it's a bigger issue. It's very front and center and embedded, of course, when we talk about coverage that could have been bought, in a more traditional way. But as you see, like in the connected car space, and I've talked about this before, but if we, God knows when it'll happen, but at some point down the road, cars will be autonomous. They may all be shared. We may not even have our own autonomous vehicle, or some of us may not. So what is the exposure then? It's not personal auto or personal motor. It's some commercial liability and a bit of property damage. So then where's that coverage coming from? Whose capacity is that? Is probably more likely to be the OEMs than it is, the OEM car makers or the Googles of the world who are powering all that and taking that liability exposure, versus Direct Line or Aviva or State Farm or Geico or whoever. So if you're in this arms race we have certainly in the US around advertising your brand in personal lines especially, where does that go? What happens to your business then? So are you taking the right steps today to position yourself to still get to exist? Maybe it's a reinsurance play down the road. And again, this could be 50 years out. So there's no CEO who it's anywhere near something that they will touch. And, most of them can't get past the quarterly result mindset. So they're certainly not thinking 50 years out till the whole fleet turns over and we have true autonomy across the fleet. But I think this is a very real thing as we start to think about what connected devices, IoT, broaden that out. I think you open up the door for more parametrics because the loss is just known. The physics are known. The event is known. All of that's known. You could just pay out. And then where's the exposure? What's the coverage? Is it embedded? Have we sort of taken away the brand value that these companies have now spent, probably hundreds of billions, globally certainly, building out and standing by? It seems like there's a need to start thinking about that. What does it mean for us in a world where things are embedded, parametric, and sort of happening behind the scenes, when we've been, buying up TV ads and Google AdWords and all that sort of thing?
Well, I think this is a really big moment in time. Um, there have been the phases of insurtech. The first was, it's disruptive. Who are these kids and how dare they? Followed by, the partnership model, which was they seem to be doing really cool things, but they can't get that far without us. So why don't we go and talk to them? And we're in that very much in that phase now. Some really good things coming out of these partnerships, but my embedded report, the embedded report we did, makes this point that you have to be careful not to give up a lot of the whole value chain. I mean, the moment you're giving up distribution to a distribution partner in embedded, you're giving up the tech to someone else who's bought the right kit and is actually in the end doing all the servicing for you, and you're only providing your capacity, and that's not a great place to be. And then that it leads on to a secondary issue, which I has again been much discussed, and I'm sure it's been on your show before. You then have to make sure you pick your distribution partners carefully, because there is this lingering belief that Amazon or Google and Apple or whoever is going to get into insurance at some stage. And there's one really good way of helping them along the way, and that's to teach them how to do it and to work with them and provide them with how you do your pricing and the tech that goes with it. So I don't know whether your audience or whether you have a view on the kind of Amazon and Google and others as a threat, or Amazon and Google as a friend. What do you think?
I think it's really unclear, and I think part of that is because I think even for two of those companies, if not all of them, they don't know yet. Google has come and gone from a number of different spaces. They've made, they owned Motorola for a time to do phones, and that never really worked out. And they still worked with LG and others on their high-end phones. So I don't even know that Google knows what they want to do in insurance. I don't know that Amazon completely knows, but Amazon probably has a better sense than Google does, or at least more of a commitment to going down some path. I'm taken to a particular example that was very near and dear to my heart around Hiscox in the US. And we were trying desperately to figure out, how do you solve for the episodic nature of the way a lot of work is changing in the SME and the contractor space, where, the gig economy was as new a word as insurtech was at the time. And, trying to figure out how do we respond to that? We had seasonal work. You have landscapers or snow removal companies, or often the same company, but they were canceling their policy in the off season, and then either buying new or calling in to reinstate, when they took that month off. And it's extremely expensive for a carrier. It's cumbersome. It's not great for the consumer, because now their policy number is probably going to change because it's a rewrite. It's not a reinstatement. So they need new certs and all kinds of other things. But also, that's not what they wanted. They just wanted the coverage to be on and off and not pay when they don't need it. And you're forcing them essentially to go to market every time they want to switch coverage back on. So there's always that risk they're not going to come back to you for it, because someone else will have come along and made them a different offer. So it's not, the solution is not just do what we've always done, just cancel it and rewrite it, and maybe put a bow on it and tell them it's something different, but it's still highly inefficient and not ideal. Hiscox, fast forward to today, is partnered with a company called Thimble that does episodic switch it on, switch it off right in the app, subscribe to it kind of coverage. And so Thimble's in my new book, and obviously I knew the Hiscox side of that equation really well. But it was interesting to see, if you go to Hiscox in the US, at least, you go to their website and it says, do you want annual coverage or do you want monthly coverage, or for short duration? I forget how they say it. And if you pick the short duration, they're selling you a Thimble policy, which is, by the way, backed by Markel, who's another competitor of Hiscox. So this is one of these, do we partner? Or do we say, they could have very easily looked at Thimble and said, sort of made a fist and say, these guys are terrible. They've figured out, we hate them. Let's do everything we can to put them out of business. But instead they recognize we can't do that right now. Do we want to lose that customer relationship if that's really what they're seeking? Or do we see an opportunity to at least still be in the equation? Yes, we'll make a bit of money on a commission side, but it's more holding that customer that customer relationship for that day when I'm sure Hiscox will solve for it at some time, as probably will everyone who's serving that market, because it'll be table stakes. But it's that mindset that I think you have to recognize, for me at least, whether someone's going to end up being a competitor or not. If they're solving for something your customers need today, that level of humility, and Kevin Carriage, who runs that business, is probably the greatest leader I've ever gotten to know. That takes a ton of humility, and it's just recognizing that if you serve the customers, the right outcome will eventually come through to you. But most people don't operate that way.
Well, Bryan, sorry,
yeah.
just jumping on that. I think it's a very good point, but there's a big difference between Thimble and Amazon. So
100%.
If you're insuring, you're partnering with Amazon, then watch out.
Yeah.
If you're Hiscox partnering with Thimble, then at some point there could be a happy ending on both sides. Thimble gets acquired, and actually, that's how Google has grown, by acquisition of Facebook. And there's all these big tech companies have partnered with smaller companies and then acquired them. So that does seem to be a sort of natural progression for the insurance companies. In fact, I'm trying to think hard now. I'm sure there are some out there, but sadly, I can't think of examples of insurance companies that have spawned initiatives internally that have been that successful. Most of them have tried and given up, or they've gone out and acquired them. And that's okay, because that's not in their nature. Clearly, it's very hard to innovate from an insurance organization and persuade people to take time away from their day job of underwriting and everything else and try and do innovation. So why not go and partner? So I think, I definitely agree with what you're saying, but I think it's a scale question. Are you going to
it's a different issue. And I mean, so the Thimble issue is less about Thimble than it is about Markel, perhaps, which would be much more of a direct competitor, similar size, similar places they're going after. But setting that aside, they're not Amazon in any way, shape, or form. Markel is not throwing their weight around. We've all seen the news about what Amazon's like to partner with, and some people love them, but there's plenty of small businesses that are crying foul. They have tremendous market power, and they can wield that. And so even if it's all great today, do they suddenly decide you're going to cut your price in half, or you're going to do things this way, and it's not a sustainable business for you anymore? And then what are you left with? I mean, it's that sort of supplier relationship has repeated itself in many different industries. Maybe we haven't thought about it in tech or services before, but there's no reason why it couldn't replicate. And if anyone has the power, Amazon or Google certainly could. I mean, Google sort of has the industry that way with AdWords, because they determine what everything costs and what words you want to buy, and they have a lot of sway over that. And what are you going to do if you don't like the price that they set? You don't really have a viable alternative. So yeah, I mean, it's a different issue, certainly. But at the same time, like Next has a partnership with Amazon for the small commercial contractor business. I give them credit for that. There's no reason why Amazon can't just buy Next or solve for it themselves. They have all the capital and tech capabilities to do it. But it's clearly an opportunity, and if you serve it well and appropriately, does that preclude the competitive threat from materializing? I don't know.
It's worth looking at, again, I think in that context, at who is doing the innovating in insurance right now, because I don't know if Matthew would agree with this. The pandemic has changed the landscape in UK, and I think we could stretch that to Europe. The earlier curiosity to know what everyone is doing is starting drying up. Insurance companies want to see now matured, validated, working propositions. They're not that interested in seeing businesses with a POC, with an interesting idea, who need a data set, the level of corporate innovation has dropped off a bit, I think, since in the last 12 months. And I think that slack has been picked up by the insurtech funding world, where now huge amounts of money are being spent on tech-enabled MGAs and validated technology that is really making a difference and is plugging the gaps, as we talked about earlier, between the capacity and the customer, and providing true digital experiences. So we're seeing less curiosity, less early stage money, and more bigger bets in companies that were started 4 or 5 years ago that are now doing really well, and a level of self-fulfilling prophecy that comes with, if you get your hands on £200 million, you ought to be able to execute properly from there. You just should.
Yeah, we should talk about funding. Matthew, I didn't want to cut you off if you were about to jump in with something.
No, just one small thing to build on that, which is, I mean, you can see what Robin's saying through the Lloyd's lab. So that's their sort of incubator, because it doesn't actually really incubate, it actually connects them into the market and does a really good job of connecting them to underwriters and soon to be brokers. But they've gone through exactly that stage where they started off with really early stage companies and realized that, as Robin says, you actually need companies that have already got some traction. And actually, it comes back to a point about innovation. Underwriters are busy and don't really have time to sort of incubate things themselves or teach people how to run a business. They want something that can be deployed within the next 12 months and start making money.
Yeah. Can we talk about funding? This to me is the greatest divide between the US and the rest of really any geography. Maybe Asia's a bit different, but it just feels like, you wake up and have an idea for a startup and you've already got millions of dollars in funding in the US. I know it's not quite that easy at all. And I'm sure for all the founders who've struggled to get funding or lived through it, it's not an easy game, but it's easier, I think, in the US to land funding than it is in the UK or in Europe. I know there's been some changes in that regard, but it still feels like the US is just, it's so much easier to get funded as an insurtech than it is elsewhere, and even pre-revenue or really, really small, relatively speaking, numbers from an ARR standpoint. Sub $1 million per year is not great for a couple people to do that, but that's not an investable business as yet. So more of a betting on something, it feels like, in the US than perhaps abroad. Is that what you're seeing? Is that still the case? Do you think that's changing? What are you seeing?
Well, we celebrated two.
Yeah, I do.
Sorry, can you go, Robin?
I do think that's right. I think the gap has lessened in the last 18 months. We would see a lot of people go to the US to get their funding. Not so much because it was easier, because you could get more off the bat. Yeah. I mean, a seed round here, 1.5, 2. If you've got something good cooking, you can multiply that several times over. If you go to the States, and then the model was slightly different in the States in the sense it was all about growth. There was absolutely little requirement on investors to show break even in 5 years' time. It was go, and the bigger the better. Whereas European investors would require slightly more conservative, and it wasn't necessarily growth at all costs. There had to be some sense in which you could show that your business was going to be making money within a foreseeable period of time. That's the gap that's closed slightly. I think the levels of ambition in the US are not quite as they were, and there's now more focus on making sure the money is spent in a mature and sensible way, and that there is some natural exit and the ability for investors to get their money back, rather than sort of a moonshot with everything you invested in.
Yeah,
Matthew, sorry.
Yeah, I mean, there's a few things. I mean, first of all, the US is just a bigger market by size. So, and there's a distinction that Robin sort of alluded to, which is where's the money coming from versus where is the application being rolled out. So if you're a business in the UK as your only market, clearly it's a much smaller growth potential than the US. I think also if you look at that funding, most of those companies that have been funded that kind of level have actually already built 1 or 2 companies beforehand.
Yeah.
Whereas in the UK, you do see a few of those, but I think you see less of them. So, and then I think the third one is, of course, no one sends out a press release when the company's gone under or returned its money to the investors. And yeah, I think we forget that there are some quite aggressive, quite rightly so, concerned money, aggressive investors out there that if they're not, I mean, growth can be different things. Growth can be revenue, it can be growth of people, it can be lots of things. But if they're not seeing that growth, they want their money back, and that will be the end of that organization or the individuals leading it.
Yeah. The UK is not devoid of big investments or big successes so far. I mean, there's unicorns coming out of the UK now. There's some recent news on that, like Tractable is one that comes to mind.
But Tractable, I mean, interesting company, and we can take some credit for this. Why not? Because Alex Disick was actually up on stage at InsTech 5 years ago talking about his crazy idea, and now they're a unicorn. But they haven't, up until now, they haven't had many customers in the UK. Most of their big part of their customers in Europe, US, and Japan. Yeah. Just moving into the UK. Zego have got unicorn status recently. We've got a couple more coming out, I think fairly soon. So yeah, it is starting to happen. But again, my point, they've got global ambitions and showing growth. And we shouldn't forget that one of the founders of Lemonade is a Brit by birth as well. So we can get some credit for that too, I think.
I didn't know that. But
that raises another point, which is the really big money has been handed out to those with a full stack proposition. The Lemonade of this world in Germany, WeFox gets a. I think investors really like that. That's end to end business. We've had many more. What we talked about them already. Tech-enabled MGAs. It's very rare for us to have people off the bat come forward with a full stack proposition. Nearly everybody seeks to go the MGA route, and at some point gets brave enough to sit down with their reinsurers and talk about getting some capacity.
Yeah, can we talk about that? And I know we're really tight on time, but I'm just curious because in the US it feels like the MGA route is that's like the laboratory stage where you're proving that your underwriting thesis and your operating model thesis have legs. And then you go full stack, and it's almost a foregone conclusion. Not 100% of the time. There are certainly some MGAs who will stay MGA, or at least for the foreseeable future. But that is, in the research for my latest book, that was the overwhelming sensation. Was it's maybe start as an agent or broker, digital agent or broker, maybe not, but MGA to full stack, because getting the statutory capital from an investment standpoint is just far too expensive until you've really proven it out. Is that the case in the UK and in Europe as well? Or is it more like MGA is a viable path and that's more likely to be the steady state, barring some other major strategic shift, versus the plan is it's just a stepping stone?
I've got a view on that. To some extent, Brian, it's a game. If you want your capacity as an MGA, you have to create the belief that you're not just doing that for 2.5 years before you go off and get your own capacity. So, you've got the same dynamic there. I mean, this is where the reinsurers play such a big part, because for many of the companies, it's the reinsurers are providing the majority of the capital up front. Some fronting company perhaps playing a small part in providing the regulatory requirements, and then I think it's easier to transition. But there are companies here who've got into trouble by moving too quickly into getting their own capacity, upsetting their existing capacity providers. There's a big lawsuit going on here between a company called Mulsanne and Marshmallow, where it's claimed that you stole our pricing models and you stole our IP in your transition. So that I think the model is the same, but I think the way people present themselves is slightly different in order to get through the diplomatic issues associated with going to get your own capacity at some stage.
Oh, that's fair. Okay,
our best MGAs will all go and get their own capacity at some point, I'm sure.
Yeah. Well, that's a whole conversation. Because MGA, when I started in the industry, was a very different thing. It was never thought of as generally as a path to being a carrier. It's just a different kind of broker. Sort of an affinity play, programs, etc. Matthew's back. I know he's losing the room. The joys of getting back into office space means you start running over in meetings and getting kicked out of conference rooms and the like. I do want to be respectful of your time, so we can certainly wrap up if everyone needs to go. But this is we could debate. I mean, there's a lot we could get into that would be really interesting, and we're only scratching the surface.
I've got one further question for you, Bryan,
Yeah.
really quickly, which is, has COVID been a true digital accelerant in the US? Because we saw signs of some digitization around, improving customer relationships, the way people worked. We refer to it as digital lipstick on a legacy pig. It has not been an accelerant here, something you would share as an observation.
Yeah, I think that well, first of all, that's a brilliant way to put it, in digital lips on a legacy pig. As a vegan, I'm not touching the pig, so I don't care. But I think it's been an accelerant on a lot of sort of low-hanging fruit, if you really want to be honest, that a lot of us just had to do, but for all sorts of different reasons, and the reasons varied by company, we're dragging our feet on. So it's good in that respect. And I think transactionally, we are more digital as an industry than we were 18 months ago. The flip side is, I think in some ways, and this isn't talked about all that much, it's been a bit of a retardant. I was going to say a flame retardant. Maybe that is the right word, but it's held us back because, and I'm hearing this to different degrees, but we've done so much in the past 16, 18 months, whatever. We need to hit the pause button. We need to digest this, or it's been too much. Now we need to take all these disparate tools that we've been sort of running offline and piecemeal and make something more cohesive and make it all fit back together with our core, because we didn't do the APIs and we didn't do the tie-ins and whatever else we needed because we had to get it out there. So there's a few companies that are sort of saying, we caught up, we're done. It's like, well, that's ridiculous, because that's not the way the market works. But I am getting some who have said, okay, now we're in digestion mode because it's been too much, too fast, and we need to make sure that we haven't just unsteadied the whole ship. So that will slow us down. But I think it also took some of the funding from the bigger, more strategic digitization that could be more disruptive or more strategically enabling of a real shift in the industry. And that's still to be seen. What I don't know is if some of these kind of low-hanging fruit bits, have they moved enough that now the ball's rolling? Or is that kind of gut reaction, like, I've just run a sprint, can I rest for a moment? Is that going to slow us down too much? I think that's going to vary by carrier, by market, by line of business, by lots of things. What would be a real shame is if we didn't take the opportunity to recognize how much faster we can move and keep that going, because there is still a very long way to go in realizing what we could be as an industry. I mean, otherwise, like the insurtechs that have these very real material advantages in operating or pricing or what have you, they wouldn't exist if the rest of the industry was moved as far as it needs to be. Because, the incumbents have all the capital, they have the existing customers, they have the distribution, they have a lot of the assets that the startups have to fight hard for. So what if they also were able to have the other operating advantages and capital advantages? I think there's still a ways to go. What's your take on it?
I would only add to what you just said that in certainly in our markets, in the London market, sort of, but the stuff that London market specialises in, rates are going up dramatically.
Yeah,
and that's some of the pause too. So underwriters are saying, we were spending all this money in an attempt to create a 5-10%, saving in this or that. We don't need to do that now because we put the rates up in our marine book by 15%, so we're going to make the money that way.
Right.
And that's not helping at all, for obvious reasons.
Yeah, fat catism, to use another animal analogy.
There we go.
I know we've run over on time. Matthew has to run. We probably all have to run. Thank you for this really interesting conversation. And yeah, we could probably go for another hour and actually really debate quite a few issues. Thank you to both of you, and I invite everyone to check out InsTech London.
Thank you for having us, Bryan, and let's do it again.
Sounds good.
Thanks, Bryan. We've got lots of questions for you, so we'll do a return match and get you on the InsTech London podcast as well.
Sounds good.
Many thanks.
Yeah, thanks all. Bye. Big thank you to Robin and Matthew for joining me and sharing a bit of what's going on at InsTech London. We did start to debate some things, and I think there's so much more we can talk about. And it's actually, a lot of it's unclear, right? We don't know how a lot of these things will play out. And that's why the debate and the discussion is so critical and important and helpful, because we need to be, all of us in the industry, mindful of the different ways this could play out. That's why I'm so thankful to Robin and Matthew and everyone at InsTech London and their partners for putting out the content they're putting out, the reports, etc. If you don't listen to their podcast, you absolutely should. Easiest way to get there is instech.london. That's it, no .com, just instech.london. And you can find out more about their events. If you're in London, fantastic. Or for their virtual things or ways to connect virtually, you can see all that there as well. But also get to the podcast, get to their reports. It really is in-depth, great stuff. So I highly encourage you to check it out. So thank you to Robin, to Matthew for coming on the show. A little shout out to my friend Paolo Cuomo, who's one of the founders of InsTech London. It's very cool seeing what happened with it as it moved along through the years and from the initial ideas that Paolo was sharing with me. And I thought was a cool thing. And I didn't really know what InsTech was because the words were just coming together. Of course, it's what all became InsurTech that we know and love and focus on so much today. So thank you to the team at InsTech London. Thank you to Medallia for making this episode possible. Thank you to all of you for tuning in, listening, watching, reading the show notes, sharing it with your friends, subscribing, rating and reviewing, giving it a like, whatever it takes to help make this content something that can help move our industry forward. So with that, I will leave you until next time. Thanks, and let's keep pushing the industry forward.